Hello everyone, my name is Philip Stevens. I am the tax director here at McAlvin's, and today we're doing a webinar on the post-Brexit trade road ahead implications of what's happened as a result of the UK leaving the European Union. It's a relatively detailed presentation. There's going to be some bits in there which are relatively technical, so if any queries do arise, please do get in contact with me or a member of the McAlvin's team as and when you're able to. So, as we know, as of the 30th of December last year, the transitional period ended, and from the 1st of January, the UK officially left the European Union. We've now entered a new era of trade and relations with the EU following the end of the transition period. And this was obviously as of the 1st of January. So businesses will have seen changes to things like exports, imports, VAT, travel, overseas work, personal data rules, etc. And in practice, we've seen quite a few queries arising in each of these topics over the last 7 months or so. So to help businesses adapt, HMRC have introduced new border and customs controls via what they're referring to as the new core model. And these have been delivered in 3 stages up until the 1st of July. So basically there was a 6-month bedding in period for all of these controls to be adapted. The idea being that this was to help business with the requirements of importing goods to the UK and giving everybody a bit of time to get used to the new process. We're still seeing people and businesses contacting us not entirely au fait with the rules, and various queries arising. So it is still something which is taking a time to get sort of more familiar compared to the old system. So stage 1 began right at the back at the start of the year, the 1st of January, and that required full customs declarations for controlled and excise goods and physical checks at the point of destination or other approved premises for certain goods. So things like bonded warehouses, for instance. Importantly, though, most goods will not be required to enter Great Britain and be checked at a border control post. Stage 2, which started on the 1st of April 21, required pre-notification and the relevant health documentation on all products of animal origin. Now, this will be relatively bespoke to people in that industry, and most businesses that don't deal with it, it won't apply to them. Physical checks will continue to be conducted at the point of destination for most goods. And then the final stage, which began on the 1st of July 21, full controls will be in place for all goods that are imported, and goods businesses will have to make full customs declaration at the point of importation. There are several points, however, within the new free trade agreement that businesses need to be aware of. These include the no more mutual recognition of conformity assessment, i.e. we don't have to abide by EU standards in terms of weights and measurements, etc. No agreement on recognising safety standards for exporting food of animal origin. Again, quite bespoke, but it will apply to some businesses. There is new red tape related to trade and rules of origin, which we will go on to later on in the presentation, and new complex VAT rules, which may require registration in multiple states. This is an area that's been expanded on over the last 7 months. We've seen some new rules come in from the 1st of July for business to consumer transactions in the EU. And in practice, it's actually quite difficult and tricky and cumbersome to get to grips with them. So the steps to take for businesses looking to deal with the EU and vice versa. So first stage is to acquire a GB EORI number. EORI stands for Economic Operators Registration and Identification Number, and is basically there for businesses wishing to trade and use this identification number in all customs procedure when exchanging information with different customs administrations. You'll need this if you intend to import or export from the EU. If your business makes declarations or gets customs decisions in an EU country, you'll need to get an EU EORI number from the customs authority in that EU country. So you could end up with a situation where you've got multiple EORI numbers depending on who you're trading with. The next step would be to prepare to pay or account for VAT on imported goods. Many businesses which aren't VAT registered will need to look at whether or not VAT is now something they need to be aware of and also registered for. Third step would be to consider commercial arrangements in terms of trade. The next one would be also to determine the customs value of goods. It's not always as straightforward as one unit. You may have bulk purchases, etc., and discounting. One of the most important ones is to confirm the rules of origin, something we'll touch on in a later slide. And finally, consider how customs declarations to HMR systems will be made and the use of a customs intermediary. Businesses in certain industries may also need to check if they require licenses for their goods or if they have to meet new rules. I did have a client earlier in the year who had a specific type of product, and luckily at this time they weren't on the licensing list, but it's something that we need to be aware of in case they expand those licensing requirements. So moving on to the rules of origin, as I said, this is quite an important topic, concept, whatever you want to call it. So the key to tariff-free trade is the concept of the rules of origin, and tariffs will not be charged where goods meet these rules, which demonstrate that the goods provided are predominantly of UK origin. Now, complexity of supply chains can mean that proof of origin can be difficult for traders to supply and hard for authorities to assess. You may have multiple jurisdictions involved in the supply chain, and therefore trying to pinpoint the origin of a particular product it can be quite complicated, quite difficult. So there are three main criteria for assessing rules of origin. The first one is a change of tariff classification. So for example, when work is undertaken within a country and it results in a change of classification. The example in the slide with regard to unique car parts is 8708, and it's different from a finished car, which is 8703. So if your country assembles car parts into a finished car, it would qualify as a change of tariff classification. The second point is a sufficient value added contribution. So the originating state must contribute a minimum percentage of the value of a product. Each component will add a certain amount of value, calculated as the percentage of the X work price of the final good. The total price of the inputs to the good, exempting transportation and insurance costs. In practice, this is where you receive an almost finished product or partway finished product, and there is significant input by your business in making that a finalized product. So what I'm saying is you can have a product which by and large is finished, but there is sufficient input from your business which then makes that a separate sufficient value added component. And the final point is on specific processing. So finished products can qualify when particular specific working or processing activities are carried out. The example on the slide says a rule may require clothing products to be manufactured from yarn. The precise rules are very detailed and can change for each product depending on what is agreed in the free trade agreement. In practice and in reality, this is quite far-reaching. Each product has its own different component makeup and processes that it goes through, and therefore each of the various stages would need to be looked at in isolation. Where you have purely UK products from start to finish is obviously pretty simple, but any that involve any type of overseas components or processes would need to be looked at in isolation. So as I said, this is quite a difficult point. It's quite an important point as well to ensure that you're getting the right charges levied or not levied. So from the 1st of January, in order for businesses to benefit from preferential tariffs when importing into the UK or EU, they must claim preference on their customs declaration and declare they hold proof that the goods meet the rules of origin. This can take the form of a statement of origin, which is completed by the exporter on a commercial document, or knowledge obtained and held by the importer that the goods are originating. So the UK and the EU have agreed to a 12-month grace period, which is due to expire on the 31st of December 2021. The businesses do not need suppliers' declarations. However, they must be confident that the goods do meet the preferential rules of origin. At the present time, as far as I'm aware, there is no proposal to extend past that 31st of December 21 deadline. But I think in the round and in obviously the various goods that can be or can have complicated rules, there may be some kind of relaxation into the early part of the year. It's something to keep abreast of. So the UK has been reliant on the EU for free trade agreements in the past, and its departure from the Union means it can no longer rely on the existing deals it had in place. And you've probably seen in the press that we've been negotiating with various different jurisdictions as to what our new bespoke UK only agreements will look like. The government has already agreed continuity arrangements with many existing trade partners and is also seeking new trade arrangements with other nations, opening up a new era of tariff-free trade. So this is a very fast-moving landscape, and will be subject to change over the next couple of years, I'm sure. So we now have a position where import VAT becomes more of an issue for businesses. So goods that move into the UK from the EU from 1st of January this year and onwards will be considered imports, meaning import VAT will be payable and customs declarations will need to be made. Businesses must account for VAT on all goods imported using a postponed accounting system. This means that import VAT on goods is accounted for and paid via a company's usual VAT return rather than paying it immediately at the point of entry. So this effectively gives a cash flow benefit to the businesses that would have, under the new rules, been hit for VAT at the date of import. And just as an aside to that, the initial postponed accounting was due to run until the 30th of June, but it has since been confirmed that this will carry on indefinitely, or at least until further notice. So how does import accounting work and how do you account for it? Businesses have to account for the import VAT via their VAT return under the postponed accounting system if the goods they import are used in their business. Business must also include its EORI number starting with GB, as you recall from one of the earlier slides, on its customs declaration and its VAT registration number if it is needed. It can then account for import VAT on its VAT return when it submits the declaration that releases those goods into free circulation from one of the following special customs procedures. So it's either customs warehousing, inward processing, temporary admission, end use, outward processing, or duty suspension. A business can only account for import VAT on their VAT return once they release excise goods for use in the UK, also known as released for home consumption. Businesses that import goods regularly can set up a duty deferment account that allows them to delay paying most customs charges, including import VAT. Through this account, you can pay the duties and import VAT you defer during one calendar month as a total sum via direct debit, either on the 15th of the next month or on the next working day after, if the 15th is not a working day. This means you can defer duties and import VAT for between 2 and 6 weeks, offering an average of 30 days credit. and settle payments in a single go rather than by each consignment on a VAT return. So now we'll move on to the actual VAT registration and place of supply rules. Businesses must determine the country where a supply takes place for VAT purposes so that they know where VAT due is payable and where to register for VAT. Similarly, if you're an EU business selling to British customers, you need to register for UK VAT as of the 1st of January. To remain VAT compliant in EU member states, businesses may need to appoint a fiscal representative. They are a special type of VAT agent for foreign businesses with a VAT registration in another country. They are responsible for the correct calculation and reporting of VAT on their client and are the first port of call for the local tax office in the case of questions or audits. We've had situations as well where clients who are UK businesses exporting to EU customers have had to register in those member states. We now have something called IOS, which effectively allows you to register in one member state, but will enable a business to then account for VAT across the whole of the European Union via one declaration. So in one client's case, that was Germany. They exported to 27 different member states over historically. So their view was that they would carry on doing so. So they set up the registration in Germany, and Germany will then declare all of and account for and assess all of the VAT for all the different jurisdictions, ensure that the right VAT is paid over to the right member state. But it just simplifies things and allows for one declaration rather than multiple declarations in multiple states. So imported goods in consignment not exceeding a value of £135 or €150, excluding specific excise goods and gifts, will not be subject to import VAT at the border and will be subject to sales VAT instead. There was something historically called low value consignment relief, but as a result of our departure, this no longer applies. VAT will now be charged on the goods as if they were supplied in the UK and accounted to HM Revenue and Customs via a normal UK VAT return. So reclaiming VAT in the EU, UK firms incurring VAT in EU countries can claim for the VAT back subject to national rules in the jurisdiction that you're dealing with. You can do so via HMRC's dedicated refund portal for supplies made prior to the transition period. This arrangement also remained in place until the 31st of March 2021 under the terms of the withdrawal agreement. VAT incurred in the EU after the 31st of December, so basically anything post-end of transition will have to be reclaimed manually from the individual tax authorities concerned. It can be quite cumbersome to do so, which is why it's always a good idea to register with an agent in that local authority and allow them to help you reclaim any VAT that may be due. Supplies of services were relatively unaffected by the transition period coming to an end. So there should be minimal impact on them. Business-to-business services are treated as though they're supplies where the customer belongs, and that customer must account for local VAT. And when receiving services, UK businesses may still have to apply a reverse charge to the receipt of services from non-UK suppliers. So this is similar to the position pre-transition period cessation. There are slightly different rules with regards to sales of digital services to the EU, something which is obviously becoming more and more prevalent, especially with the pandemic and a lot more online type of services applying. So after the 31st of December, all suppliers of digital services to consumers in EU member states are liable for VAT in the consumer's member state. The £8,818 annual threshold for cross-border sales of digital services to EU consumers will no longer apply. I think this rounds up to roughly €10,000. And organisations must charge VAT at the rate where the customer is based and declare those sales to the relevant EU member state. UK businesses that had been using the UK VAT MOS union scheme can continue to use the scheme, but must register for VAT MOS non-union scheme in an EU member state, as I mentioned earlier. Personal data. The EU has agreed a period of 4 months, extendable by a further 2 months, in which data can be exchanged in the same way it is now, as long as the UK makes no changes to its rules of data protection. After this period ends, the data rules are likely to remain relatively unchanged, as the UK businesses will need to comply with UK data protection law, and that was drawn widely in line with general EU law. Businesses will need to comply with any changes to EU GDPR if they offer goods or services to monitor the behaviour of individuals in the EEA, and a review of the data you hold and your data transfer and protection procedures are recommended. And since the production of these slides, I'm pretty certain that the extension has remained the same and no rules have really been changed. So for existing EU workers, employers should check whether these employees from EU member states need to apply to the settlement scheme. A person is eligible for settled status if they started living in the UK before the end of the transition period, i.e. December 2020, and had lived in the UK for a continuous 5-year period. 5 years continuous residence mean that for 5 years in a row they have been in the UK, the Channel Islands or the Isle of Man, basically UK dependencies, for at least 6 months in any 12-month period. The deadline for applying for settled status was 30th of June this year, and there was no extension to it, although individual cases can still be heard as a special dispensation depending on the circumstances. New non-UK workers, after the transition period, you can still recruit EU citizens, but you will need to apply for permission and obtain the necessary visas. To recruit workers from outside of the UK in the skilled worker category in future, you will need to demonstrate that they speak English at a required level, they have a job offer from a Home Office licensed sponsor, the job offer is at the required skill level of RQF3 or above, which is the equivalent to UK A levels, and they'll be paid at least £25,600 or the going rate for the job offer, whichever is higher. If the job pays less than the £25,600, but not less than £20,480, the applicant may still be able to apply for permission by trading points on specific characteristics against their salary. A business must also apply to be a visa sponsor if they intend to recruit from overseas. So there are now new travel rules relating to the EU, Switzerland, Norway, Iceland, or Liechtenstein. Not that many of us have been traveling much in the last 6 or 7 months and slightly further than that. But the new rules, new requirements state that UK nationals will need a visa if they want to stay in the EU for more than 90 days in a 180-day period. So should you or any of your representatives of your business need to travel to the EU in future, you may need to consider the following: your passport, travel insurance that covers your healthcare, because obviously there's now no EU-wide cover. Check that you have the right driving documents. You need to tell HMRC you'll be working for working in the EU. Check whether you'll need to pay social security contributions in the country you're working in. The UK does have some reciprocal social security agreements with various jurisdictions, so you need to check on an individual basis. Check whether you need indemnity insurance for your employees, and also check you've got the right documentation to take goods to the EU. UK professional qualifications won't be recognised automatically in the EU anymore, and it will make it more difficult to work there, especially for those in service sectors. Those looking to work for longer periods may need to acquire authorisation via a work permit. for most EU countries if you're a UK citizen. In most cases, you'll also need a job offer from your chosen country so that you can get a visa to move there. You need to check with the UK-based embassy of the country you want to work in to see what is required of you and what documentation is needed. This is, quite a departure from how we were pre-transition period, because you had the freedom of people and movement clauses, which we no longer benefit from. That's pretty much it. So like I said before, if you do have any queries or any questions on any of the points raised, please do feel free to contact myself or one of the team. We're happy to run through it with you. And thank you for listening.